Thank you, everyone, for listening to me this evening. I run with Laura Henderson Opportunities Trust, and it is different to everything else that we do here at Henderson's, and it's different to every other trust in our stable, in that it focuses across the market and genuinely across the market in the UK. We buy very small companies for this trust. We buy large companies for this trust. It is small, so we hope to be nimble and able to utilize its small size. And at the moment, we have been and it's been for a few years, focusing on the smaller companies, particularly the very small companies. We believe that too much time is spent, too big a premium is spent for liquidity. And we think some of the less liquid holdings are where the extraordinary value can be found. That hasn't been the view of many investment managers. And in recent years, there has been a move away from smaller companies. And now I'm just going to move on a slide to just show our objectives. I apologize. I apologize about this. Here we go. Here we go. Our objectives are to invest in UK companies across all sizes. We try, small companies over time have given very good returns. They don't always, in certain markets, and the last couple of years have been them, where smaller companies have lagged larger companies, and we therefore have some exposure always to large companies. We don't buy a small company unless we think over time it's going to grow much more than a bigger company. We also, with the portfolio, and we don't aim for it, but we do get a growth of dividend from the underlying holdings, and the portfolio is at the moment yielding about 3.5%. But it is an exciting portfolio to run because we're looking at opportunities everywhere, and there is 40% of this fund is in AIM stocks, because that is where people aren't paying attention. That's where there are really stocks that have got unique qualities. They are going to show good growth over time. It's an area where there will be problems, but there's also an area of excitement. And just moving on a slide. So actually, the next 3 slides are going to be in all Henderson presentations going forward, and they say a bit about Henderson's. And for me, they're always interesting slides to read, because I've actually been at Henderson's since 1983, when there was now I read there are 24 offices worldwide. When I joined, there was only the one office, and there were 170 employees, I think. Well, in total, and we were doing all the admin then too. And nowadays we don't do all the admin, so the 2,000 is a totally different number. And we are a large. I now work for a very large international company, having been a very small UK business. I see that we now have over $300 billion under management. I think when I joined, there were 750 million pounds under management. So things have changed. They've changed around me, but the business always had a focus on investment trusts. The business at the time I joined was owned by its investment trusts, and so for me, they've always been the client that I've focused on, and and some of the clients, some of those investment trust clients, are obviously still with us. 2 that I do, Lord Bencher and Lowland, have been there the whole time. This fund was actually started in 1985. I remember it being launched. It was launched at £1, and I think the shares are now £10. And during that period, it's also paid dividends. And it always has invested in what was then called the USM, and the unlisted securities market was always a large part of it. That USM is now really the AIM market. So we've always been in that area, and it has had volatile returns, but over time, from that £1 to that £10, it has added value, and as I say, it's yielding 3.5% on top of that. So it's interesting looking at these history slides. This is another just on Henderson's. What we're doing is, you see, I'm just in the equity department, where between here and the US we're managing just short of 200 billion. The investment trust bit of the business is about 3-4% of the total assets. And the final one of these sort of on Henderson's, this shows perhaps the breadth of the team. When we look at the portfolio, we'll see there are 90 holdings. People say, you've got 90 holdings in Hot, James. In something like Lord Adventure, you have 140 holdings. How are you following all that? Well, there is a team. There are large teams here, and but particularly in the bigger companies, we're talking to people in the analysts in the UK, and also in Denver in the States, where there's a very strong team of international company analysts, and they are following some of those big companies that are in the portfolio that add to the ballast and the overall blend of the portfolio. So this is just a bit on Henderson Opportunities. As I say, started in 1985 by Richard Smith. I was his assistant when he launched it, I remember. When Richard retired, somebody called Colin Hughes managed it, and I've managed it with Laura since 2006. And the objectives, we've sharpened the wording. Maybe we've sharpened the wording of the objectives. We've certainly changed them a bit, but the actual idea of being in across the UK market and in smaller companies hasn't changed. We've always used a bit of gearing, and we limit it to 25%. It's at the moment about 12. We wouldn't normally take it up to 25, but that other than I think in 2007-8 it got up to that. When on the market fall, we were able to keep buying a bit of stock, and we took it up to near that, and that proved to be correct. The 2010, 11, 12 years were good years in the trust, coming out of the recession, with gearing, with companies that had fallen out of favor, companies that had been sold down unnecessarily hard, meant that 2011, particularly 12, were years of very strong return. We go through the risks in the portfolio, and yes, there are always risks in equity funds. How do we try and mitigate those risks? Well, we mitigate them by running a relatively long list of stocks. And it's not enough just to run a long list of stocks. The actual underlying companies need to be diverse. They need to be working different areas of the market, of the economy, and that way, hopefully, we take some of the risk out. We certainly take out some of the stock-specific risk. What we haven't taken out is that the UK as a market is out of favour with investors, and UK small companies are particularly out of favour with investors. That's across all small companies that's been happening, and we can see with the levels of takeovers that have been happening over the last year or two, that people outside the market, outside general investing in the market, are thinking that. Other risks that are here are something like discount risk. The fund is on a discount of 12 or 13%, around that at the moment. We work hard at trying to tell the story, and sometimes during the time I've run it, it's been at a small premium. We've one of our trusts at the moment is around asset value, one of our larger trusts, but it's more in big companies at the moment. Smaller companies are the area that people feel least comfortable with. And I'm going to try and tell you why I'm excited and why we're dealing in that part of the market. So the last 3, 5 years, 10 years now look disappointing. Over 25 years, this has worked in smaller companies, but now I almost know the day when the relative performance of this trust tailed off, and that was the day of the Brexit vote, because this trust is much more in the UK economy. It's also got more in companies that have, because they're less international, they're being focused in the UK, they have had more disruption from Brexit. But it's not just been that, it's been that those earnings have been downgraded by the market. There has been uncertainty. Overseas investors haven't felt comfortable buying the UK since Brexit in the way they were before. Maybe all that is changing. Not all, maybe that is slowly changing. We've 2016 to today has been a period of adjustment, and in that adjustment has led to a lower valuation. But maybe we're seeing a stabilization in those values, and maybe we are seeing the first signs of international interest in UK equities. UK, it starts in the big companies, and it will filter down in time to smaller companies as confidence builds. And maybe we're seeing that in the shorter term numbers. I wouldn't necessarily really go overboard on how I'm claiming that, but there is real value down there, and it slowly does come to the fore. This is a chart of discrete years. It shows you something like the 2013 year, that we're still seeing that recovery at that stage from the 2008 sell-off. This trust has always done better in the recovery years. This trust has always done better when people see interest rates fall and interest rate and economic growth comes through, because it's in the UK, and it's got more in companies that are more tied to economic activity. And as I'm going to argue later on, I think there are signs UK economic activity is picking up, and interest rates are likely to start to fall later this year. And that is the background where this type of trust is well positioned. So what is that positioning? Well, we instead of doing it in straight sectors, we tried to show it like this, because this is how we see it. What we're wanting is a blend of exciting growth companies, smaller companies, more stable smaller companies, recovery situations, and then what we call the stabilizers. Those are the large companies. They're the ballast to the portfolio. And the other area stabilizers are the natural resources. It's quite perhaps strange to call natural resources stabilizers. But when oil price is moving up, many companies on the left will suffer. Engineers, industrials suffer when oil prices shoot up because their costs go up. But then there's this part of the portfolio, the natural resource companies, they should hopefully be benefiting. And we saw a bit of that when the Ukraine war broke out. We saw oil go up, we saw industrials come down. So in that sense, it's a little bit of a hedge, the natural resource bit. But it's the left-hand side that's different to other trusts. I hope there are going to be names in this portfolio that you haven't got in any of your other trusts, investment trusts you hold. And it is this that differentiates it, and particularly the early stage and the small companies, they are where when this trust performs strongly in coming years, it will be them that drive that. It is there that there are real opportunities. We're also always looking out for recovery situations, and we have had some in recent years that have gone well, and we're always trying to refresh that area. So how does it split between those different areas? It is the small cap compounders, 29% recovery situations. We would take them out higher when we get confident, and we will fund those small companies, early stage companies, by reducing that large cap weighting a little bit further. It will help fund particularly those two, early stage and the small cap growth, where I think that's the neglected part of the market. It's the part of the market that has hurt us most in recent years. It's where there's some big hits have happened in share price as people leave the area. That is where you go through the wreckage in some of that small cap area and that AIM cap area. That's where the gems are to be found. We'll give you an example of these different sorts of companies. This is Creo, and I put the chart there because actually operationally it's making real progress. This is medical devices. It's had some figures today, and I will be talking to the management shortly. But it's actually getting real traction. It's selling to hospitals. Its devices makes surgery less invasive. It means you get out of hospital so much quicker. It gives so much more precision to the surgeon. Yet the share prices wouldn't reflect all the progress that's genuinely being made. And you only need to look at the sales line. The sales line is now moving forward strongly, but people don't want to take on the risk of owning these sort of shares, and there are always risks involved. It's an example of the kind of stock that we've got in hot that we haven't got anywhere else in house, and I don't think it's probably in many investment trust portfolios. At least I know it isn't. And it is genuinely exciting, and it could be on the cusp of some very, very substantial growth. So that's the kind of early stage company that's a leader of tomorrow. High tech, answering a problem, could be really disruptive in the marketplace, in that this makes surgery so much, moves surgery on really substantially. This is more of an established small company making good returns. Every year it's coming through with them. It's doing software for the railway industry, sorting out timetables, and they do need sorting out sometimes, and it's getting more and more work in that area. It's come through with genuinely solid results, and you can see the share price progression because people are looking, when they're buying smaller companies, they're looking for that element of safety at the moment. They're not looking for that really substantial growth, because they haven't got the confidence to believe it will come through in something like Creo. That's why Creo's been downrated. But this, you can feel comfortable. It's generating cash and it's growing its earnings, and you can see the share price has moved up, unlike so many smaller companies over the last 5 years. But in fact, during that period, the actual valuation on the company, the rating on those earnings that it's making, has come down. So though you're seeing some share price appreciation, the value put on those earnings suggests that there is substantially further re-rating. There's a chance of re-rating in a better investment climate. Morgan is, again, a substantially better company. I've followed Morgan. It used to be called Morgan Crucible. It's now called Morgan Advanced Materials for many years. And it is, under this management team, a substantially stronger, better business than it has been in the past. Again, the rating on the shares, the valuation of its earnings has come down to lower than I've ever known them before, yet they are better quality earnings than I've ever observed them to be in the past. This is the kind of company that actually the earnings can surprise substantially on the upside in the coming period, because it's taken cost out, it's focused on its business, it's thinking what does it do well, and is doing more of that. And what it needs is a little bit more sales growth, a little bit better environment out there for selling industrial product. And then the operating, with a bit more sales growth, the operating margin will open up because they've got their costs so well under control, and those earnings will come through stronger than people think. It's a very sound business. It's in a tidy niches. They're relatively small niches in its product, in its products, but it is a leader in those niches, very much a global leader in those niches. This is a recovery share, STV, Scottish Television. It's the ITV of Scotland. Very low multiple now on these earnings. And these earnings can again move forward substantially when a little bit more confidence returns towards advertising. At the same time, it's got a good production side, a little bit, and which is moving forward nicely. And that's good quality earnings. A little bit on advertising, increased advertising spend, and again the operating leverage in the business is relatively large, a little bit more on the top line, and a lot of that flows through to the bottom line. And you'll see need for earnings upgrades from this very low 6-7 times earnings level. You could see a re-rating as well as increased earnings. So those are the smaller differentiating companies, very different sorts of businesses, all doing different things, addressing different markets, and it's that differentiation that means that that there isn't one theme driving this portfolio. So if that theme goes out of favour, it won't matter. There are lots of different themes going on, lots of different companies with different activities, and then to try and take some of the volatility out. And to be honest, we haven't had enough of these sort of companies. Are some of the big companies. Something like we don't buy them or own them because we don't think they'll grow or that the share prices won't perform reasonably well, but they bring some stability to the overall mix. And one that we've increased in recently has been GlaxoSmithKline. The rating on GlaxoSmithKline is relatively low. It's the kind of company I was speaking earlier about international buyers last looking at the UK again. It's the kind of company they will come to buy early on as they look at the UK. What's in the UK? I know it's been very cheap, I hear them say. What's a good business? What's a big liquid business can we buy? It is the Glaxos that they will look at. At the same time, the Glaxo rating's low. The management has taken action. It's really bedded in the senior management team over the last couple of years, and we expect the earnings to move forward nicely. Yet, as you can see, the share price has done nothing in the last 5 years. And also, I said amongst the stabilizers, there was also this exposure to oil and natural resources. Jersey Oil and Gas is going to should throw off substantial amounts of cash in coming years. It's very well positioned now in the Beaconsfield and the North Sea. The rating is very low on it. People have been uncomfortable with holding companies that have got an exposure to fossil fuels. And actually the whole area of the North Sea has seen very negative sentiment because of the windfall taxes, and that's all now priced in. And actually this company is going to be generating substantial cash as that Beaconsfield comes into production. If the oil price were to go up, it would be a real beneficiary. But even at this oil price or lower oil price, it will still throw off very substantial cash later on from 2026 going forward. So that was just a flavour of those things in the portfolio from the different areas. What are we doing at the moment? As I said, we are looking through this smaller company area to find hopefully the good winners for tomorrow across a diverse selection of companies. And these are the 6 that we've been buying recently. I'll pick out 2 or 3. So some of them have been bigger companies. Something like Flutter is in the FTSE 100. But what's happening in America, the opening up of gambling in America means companies that know about gambling, and Flutter owns Betfair, it owns Paddy Power, are the winners. It's an industry the UK is a leader in gambling, and Flutter is a real growth stock. That's a very big business. 29 billion market cap. Because of the States and places like Brazil, you're seeing very substantial top line growth coming through. Yes, there are expenses establishing those businesses as states open up to gambling, but Flutter has a very large market share in these states that are opening up. Obviously the UK is more difficult for Paddy Power and Betfair. It's a small part of the business. What's really driving it is America, but the disciplines learned and the stability of something like the Betfair franchise gives the company a base from where to grow overseas. So that's a big company. Take the other end. This is a small business. AFC. That is. It's electrolyzers, it's hydrogen fuel cells. We've got a bit in these early stage alternative energy stocks. There will be big winners in this area. The move away from fossil fuel to hydrogen, to solar, wind, maybe nuclear is happening, and hydrogen fuel cell companies will, we believe, be part of that mix. AFC has got product out there. It's got product in the field, and they appear to work well. They're being tested by some very large companies, but they're also being genuinely used out there at the moment. So this is their product particularly replaces the diesel genset that you see for instance, on building sites, and the big contracting companies are looking at it and trying out as they move away from using diesel to using it in a small way, and it's at the moment hydrogen, but the speed of change will pick up over the next few years, and AFC could definitely be a winner in that. Something very different is Workspace. They're repurposing buildings. There's one round here. It was a miserable office. It's now become more of a tech hub, and there's a real role. There's a real need for good quality space, and Workspace is doing that. Whilst Marshalls is the buildings material company. Yes, people are worried about the low level of activity in building, but Marshalls have been here before. They know how to manage themselves in quieter times, and they are the leader. For instance, York Paving Slabs are the market leader. They've got the quarries. They'll be there when the recovery comes through, and they will be leading it. So that's some of the stocks we've been buying. Say it's a mix of stocks, a large mix of very different sorts of businesses, different drivers, all of which we think will grow well going forward. And I'd like to talk about any of them if you send in your questions to Dennis. But just a bit more standing back on the portfolio. Yes, we've got the top 10 holdings there. It's a long list. What do I say about the top 10? They are all very different companies. Last year, Rolls-Royce was our best performing share. It came from that recovery pool. It's now probably in the big company section rather than in recovery. So some of that recovery has happened. It's generating cash. It's going to be paying off. It should be paying off down its bonds. Its credit rating is going up. because air miles flown is going up. It's got, I think it's just because it's gone up, it's not, doesn't mean it's got a long way to go. So that very different to some of the things further down the list. Next 15 is it's an advertising. Springfield Properties is the largest Scottish house builder, very cheap share, I think, at the moment. Whilst Boku is a big international company. It's payment systems on your telephone, being used by Apple, being used by Amazon, used by Spotify. It's payments from the phone are very different to Serica, which is again back to North Sea and gas, or Traxys, which I've talked about. So it's diverse, but all of them genuinely have got real growth potential. Some will disappoint, but actually the ones that succeed will succeed in a much bigger way, that because it's not symmetrical a failure. The things that go up can go up substantially, but that you've got limited downside along a long only position in a share. And why are we confident about the valuation being low? There's so many different ways of looking at valuations, but what we've done here is just looked at the sales, price to sales. That's how businessman perhaps looks at a company. What are your sales? And then I can tell you how much I can pay for your business. Well, the sales for this portfolio are at a lowest level I've known in the years I've been involved. The sales to the market cap. So for every pound of market cap, you're buying more sales than ever before. So that's a valuation technique that's clean and signaling very cheap. Just been told I'm waffling on too long, and it should be more time for questions. So I'll just hit the summary slide. So 43% of this portfolio is in AIM. AIM, and we're unashamed about that. It's been wrong in recent years because AIM has derated. But to be looking in that area, to be adding in that area, will give good long-term returns, we believe, as the real strong businesses of tomorrow, the large companies of tomorrow, will emerge from AIM over time. And we'll look across the market. We will work hard to get the discount down, which it does on a better market. This will be a portfolio people will look at and think, how do I get that exposure to AIM? Look at those names. I haven't got them anywhere else in my portfolio. Look at the growth that's coming through. And that will lead to discounts tightening, we believe. At the same time, the valuation of the underlying holdings in this portfolio are very low. We are losing a few companies by takeovers, which is a pity because the people buying are getting good deals. But it does remind people how cheap some of them are. So with that, we got an appendix talks about our ESG. Perhaps, hopefully, we're being front foot on the ESG. We've got companies like AFC or Ceres, another fuel cell company, where I believe it'll be they're very volatile share price wise at the moment, but actually they are solving a real problem. This need to move away from fossil fuel needs companies that provide alternative energy to emerge. And I believe that these are two of the ones that will come through, as will, I believe, ITM, which is also in the portfolio. So with that, I will shut up. And Mike is looking at me. Mike, do make comments or questions.
Oh, thank you for that, James. Very good. And well, it's difficult to pin down the nature of the trust, really. I was quite interested because I've not looked at a trust like this before. So it was a useful run through to understand your portfolio a bit better and your investing style. Just a reminder to everybody, please type in your questions now. Now's your big chance if you want to get anything answered. There's a couple already here, so I will quickly go through those. And in the meantime, everybody else keep typing away. What holdings have you sold recently and why? That comes from Colin Hughes.
Colin, it was good to have Colin here because Colin ran this portfolio very well between me and Richard Smith in the period of.
Oh, really? Okay, so
Right.
he's got the inside
Unless,
track here.
unless there's another Colin Hughes out there.
Right.
And Colin does very meticulous and good research into companies, and I will take him up afterwards to find out what he's actually also looking at and buying at the moment. I look for ideas everywhere. As regards selling things, we are selling some of the bigger companies in the portfolio to fund some of the smaller stuff. The bigger companies are some of the ballast to the portfolio. They hopefully bring some stability. So a company that we held and have sold completely out of is Lloyds Bank. I think there's nothing wrong with Lloyds Bank. We hold it elsewhere, but it hasn't got the growth prospects that we can find in the medium and small, some of the medium and smaller companies at the moment. So yeah, and that's the direction of travel. Lloyd's, yes, fine bank, rating relatively cheap, but actually growth prospect not substantial. So we sold Lloyd's Bank.
So in a way, yeah, I mean, your philosophy involves timing the recovery of the market to some degree, doesn't it? I guess you're hopeful that there's a turn coming for the small caps in the UK, and you'll see valuations starting to climb from what you believe to be around the bottom of the market, and that's your reason for switching out of these large caps and releasing funds to go into small caps.
That's right. We had moved, sold some small caps, and we never sold enough of them in the last real turn up boom in small cap. At the time, we felt we were doing quite a lot. For instance, after the COVID period, small cap had a very nice patch, and we did sell some small cap, and I felt I was doing quite a bit. In hindsight, we didn't do enough. And we bought things like Lloyds Bank at that time, and we made some money in it, and we've now moved away from it. I'm not sure about timing as such. It's more we don't know when things turn. I think things might be turning at the moment, but it might not be now. We might have to be patient for longer. But you never time these things correct. When things are cheap, you should act on it. You don't have enough good ideas. There are not enough good opportunities not to act when you see them. So yes, that's our direction of travel, to sell some of those bigger companies and to buy the smaller companies. But we're not trying to time it as such. The valuations are just so substantially low at the moment. We need just to get on and do it.
Okay, thank you. Bill Hall wants to know, there are 3 big banks in your top 10 holdings, but there are no oil majors such as Shell or BP. Why is that?
There aren't any small banks as such. There isn't a small NatWest. And the banks are different. So the Far East banks, the HSBCs or the Standards, are very different to the UK high street banks, and the Far East banks do bring a blend. A lot of this portfolio is tied to the UK. At least those banks bring Far East exposure and different growth characteristics. As regards the big oils, we've got small oil companies. Unlike banks, there are small oil companies. So we do have and I spend quite a lot of time on smaller oil stocks. It's a really unloved, difficult area, and that is the opportunity. People have moved away from those companies because they're worried about their fossil fuel exposure. There have been disappointments in that area, and there's been the tax regime change in the North Sea. These have all added up to very low valuations for some of these, particularly these North Sea exploration companies that have got success. Say exploration, they're moving into development phase. These companies, the oil is there, and it is going to come out, and it is going to give good returns, I believe, to shareholders over time. So that's right. It's a good question. No, it's that the big banks bring a blend and bring something different to the portfolio. There aren't small banks. If there were small banks, I would be looking at them hard, because I genuinely, my default position is a good small company will outperform a good big company over time, and that's been the experience. It's easier to grow from being £100 million company to a £1 billion company than it is to go from a £1 billion company to a £10 billion company. There's more opportunity in smaller companies. So, but with the banks, no, there aren't those small banks.
Okay. And Gavin Laidlaw is asking, well, he says it's good to hear your enthusiasm. And are companies getting their messages over? What is wrong with broking these days? Your thoughts?
Oh, thank you, Gavin. I don't think there's anything wrong with broking. I think there's been a lack of success of companies coming through with the results to get investors excited. I think there's been a lack of fund managers haven't been making the case necessarily for their funds. So I'm keen to try and do that. I think when we see better returns improve a little, we will see interest. It's a competitive business, and if people see share prices moving up, there will be much more interested in some of the meetings. I know some of the meetings for smaller companies at the moment are a little bit lonely. There aren't enough fund managers looking at these companies, but that is the opportunity, and that's why we're doing it. We're not doing it because we have to be in smaller companies. We're doing it because there is the real opportunity in them at the moment. I think I've just come back from the States, and when you see the States, you see a huge community of investors helping their small companies. And for some reason, we've lost a bit of that in the UK. It's partly that that some of the companies in the States, as I say, have been very successful, and that's bred success. Success breeds success. And the West Coast, I was on the West Coast, I was in California and San Francisco, and there is a real buzz in the smaller company community that we haven't got in the UK at the moment. But it's not to say it won't happen. It's a totally different experience out there than 20 years ago going out there. That was before they were feeling shell-shocked and beaten up 20 years ago. And no, it's a totally different world now. And a lot of their successful companies are not more than, well, the one I was looking at was only 7 years old. And it's a several £1 billion company now in the States. It can happen, and it can happen quite quickly when it happens. It obviously is, everything's smaller in the UK, but that doesn't mean there won't be some real success stories coming out of the UK.
Okay, thank you. Mike Newman still remains to be impressed. He's saying the share price today is the same as it was in 2014, 10 years ago. Is that really worth investing in? He's asking if you've perhaps got an annual dividend yield of around 10%, maybe, which would compensate. But maybe you could just, I think you talked around this a little bit earlier anyway, with the kind of Brexit impact probably intervening around 2016 or thereabouts. But did you want to say any more about the share price over those 10 years?
Yeah, well, I agree. I completely agree with you. Over 10 years, it have made no progress in the share prices, disappointing. There have been dividends in that period. And as I say, 2016 was June 2016 was the period when smaller companies, UK assets, started to get down-rated, and I believe that's played itself out. I suppose I think that rather than say that's the reason not to invest, for me, it's one of the reasons to invest, that it has been difficult with valuations falling, is the opportunity. When things have gone up and valuations are high, that's when not to invest. That's when you should be selling things. It's when things are on there, down, and they're not going to fall through the floorboards. That's when and I don't believe we are falling through the floorboards. I believe we're going to rise from this level because the underlying good. Underlying companies, some of them are going to come through strongly over the coming periods, and the valuations are low, so it's down. But that's why you should be looking. There's an element that I think contrarian investing does work, and momentum investing can be dangerous. We've got to prove that.
Okay.
We've got to prove that in the coming periods.
Okay, thank you. Just as an adjunct to that, actually, I was looking at Morgan, one of the examples you gave earlier, and they've got quite a bit of debt on the balance sheet that's been creeping up over the last 2 or 3 years. Is that a concern where you've got these relatively small companies with maybe pretty lightweight balance sheets? Maybe they're still paying a low percentage rate on the debt because they haven't rolled it over yet. But at some point, that may be hitting them quite hard in the next year if they've got to roll over their a good chunk of their debt. To what degree does that concern you at the moment?
In a company like Morgan's, it doesn't. I mean, Morgan's got real assets and it's getting a good return on those assets. So a bit of debt is actually not a bad thing. Debt's not a bad thing for them because they're getting that good return on equity, and they're generating cash as a company. So, and actually for a company like that, a little bit, some debt isn't a bad discipline. When certain companies have too much cash, they find a way of burning it. You suddenly think, let's go and buy that. Whilst actually, when you've got some debt there, when you look at something, you've got that constraint, that focus. Is it really worth it? So that's an unpopular view at the moment. It's not the view of most investors. Most investors are very uncomfortable with debt, and companies that have and what you were saying, Mike, it resonates with a lot of investors, but it's not always the case. If you're getting proper return on equity and you're a stable long-term business with real assets, you should have some debt in there to help boost those returns. Companies that are burning cash, companies that are early staged, yes, they need cash. And early stage companies never really have enough cash in the UK. So it's one size doesn't fit all. You need different sorts of balance sheet structures for different sorts of companies. And Morgan's though it's a small company, it's a relatively old, mature company in some ways. It's in good niches, but and that type of company, some debt is good in the mix.
Okay, thank you. Colin Hughes again. He asks, in 2021, the NAV and the share price hit £16 briefly, which I guess must have been an all-time high. We're now down to around 10, I think. So what were your thoughts at the time, and how did they evolve over the subsequent years?
Very good question, Colin. It was 21. It was just post. It was coming out of COVID that there was this extraordinary run in smaller companies, and particularly in some of the early stage companies. For instance, our alternative energy stocks really took off. Hydrogen became a big theme, and we did sell, but with hindsight, we should have sold the lot. We were trimming and cutting and trimming and cutting, but we should have just walked in and sold the lot. It's not the usual way I behave. Usually, I do things. I'd cut gently on rising prices. And we were doing that. We took out the money we'd put in. We took out a bit more into the alternative energy stocks. Then we took out a bit more. But actually, something like Ceres got to 15, 16 pounds, and now £2 or £3 or something. And actually, the underlying business has got better and more, and has actually got real customers now. But it got overblown. Why didn't I sell them all? Well, I kicked myself hard about it, Colin. But why didn't I sell them? Because I actually think in the medium term, long term, the move away from fossil fuels is real. I wanted to stay exposed to alternative energy. I should have, with hindsight's a wonderful thing. But I should have sold the lot. We reduced more than half. We sold over half the holding, but and then the fall, the hero to zero of the market is quite extreme at the moment. Luckily, something like same for AFC, at least they used that period to raise cash. So they're actually got the balance sheets to get themselves through the next period. So it wasn't totally wasted, that boom by companies, but it was an extreme boom in that area. It was a bubble to a certain extent. At the same time, and that the share price of HOT moved to a premium as smaller companies came into favor in that post-COVID time. And so we've moved from a premium to a discount. At the same time, there's been a crunch in the valuation of smaller companies. I thought, I was reducing, and I was reducing, but I didn't reduce enough. I didn't use that.
Yeah.
Period.
Okay. Thank you. Bill Hall asks an interesting question. HOT is a relatively small trust. Would it not make more sense to merge it with a bigger trust, such as Henderson Smaller Companies? Is this one of the reasons why Saber Capital, an activist shareholder, has propped up on your share register?
Yeah, I think that's a good question. Why do I want it to stay independent, HOT? As I say, I think a lot of small cap funds are actually becoming 250 funds. They're buying mid cap. They're not buying small cap. The area that's really just where it's loneliest and the biggest opportunities are, because people aren't paying attention, is in the small cap, the micro cap. So I don't think fund mergers will answer the problem. I think the real opportunity is actually being in the smaller trust, if you're doing small cap investing, so you can utilize this period of real value opportunity in smaller cap. The Saber on the register, shares are there to be bought and sold, and I think Saber will probably made a very clever investment. And I think people can see both a discount fall and underlying share prices going up, and they'll do very nicely. I have to say I prefer it if the small cap, these companies, these trusts were owned by private individuals who would enjoy it rather than big institutions. But that's why I'm pleased to be talking with you tonight, Dennis.
Encourage a few more of us to buy them. Yes. Okay. Just on what's your discount management policy? Do you go into the market and buy shares back?
No, we haven't. And why not? It's quite a small trust anyway. I run open-ended, I run closed-ended funds. The thing about open-ended funds, and where you're always got money, in bad times, you've always got redemptions. You have to sell the underlying stocks to meet those redemptions. I think discount control mechanisms in small companies are a real pity, because it means you're always on the back foot in difficult times. Whilst Colin talked about the period after the COVID, we were able to buy stock in that COVID period, and that really did help coming out. It helped in 2008-9 to be able to have a closed-end structure, not looking over your shoulder, to be able to really make use of opportunities. Our discount control policy is to try and tell the story, Dennis, to engage with shareholders and tell them what an opportunity this company is to make money for them. And I think that's just better than buying back, where buying back, you in the end, you miss out on being able to buy good quality companies. You begin to think your liquidity, your portfolio has got to be greater, so you don't buy small cap, you buy things you can sell. And there's already a premium being paid by the market for liquid companies. And the great thing about investment trusts is they're a pot of money. to grow and use opportunities across the market, and we'd be limiting ourselves if we were to be buying back shares. But then at the end of the day, it's not my decision. It will be a board decision. I will argue like that, and the board may or may not listen to me.
Yeah. Okay. Thank you. Just on the dividend, then, Gavin Laidlaw's come back with a question about the dividend yield. It's I think it's around 3 to 4%, that kind of area, isn't it? Is that an important part of the strategy, is to maintain a consistent but modest dividend yield, or would you what would you do if you return to significant growth? Would you allow more capital appreciation, or would you push more into the dividend, or how would that work?
Well, the dividend at the level it isn't high for the market at around 3.5, but it's reasonable, and we'll just keep growing it. I don't try. I don't look at. I don't manage the dividends that are coming in. I just see what comes in, and we pay out a growing amount of dividend every year. So it doesn't. It's not an income fund, but it will. The board has said we will have a progressive dividend policy, and they have been progressive in recent years, and they'll keep along that line.
Okay.
The real way to grow a dividend is to grow the capital. When you've got more asset to provide that revenue, and the focus is growing the capital, and we've got to get growing that capital, and I think we're well placed to do that.
Okay, thank you, James. Well, that's bang on 6 o'clock, so your timing is perfect, and that was the last question. So I'd just like to thank you, James, for joining us today, and for talking through Henderson Opportunities Trust for us all. And I'll certainly go away and have a little bit more of a deep dive and looking at your portfolio now that I know a bit more about the trust. So thank you, and hope to see you again sometime soon.
Mike, thank you very much, and thank you everyone for listening.